Hello and welcome to Money Maximized. Today we are going to talk about inflation's currency dance. Inflation and currency exchange rates are closely intertwined and have a reciprocal relationship. Changes in inflation can impact exchange rates and vice versa. Here's how they are connected. Purchasing power parity. According to the theory of PPP, in the long run, exchange rates should move towards the rate that equalizes the prices of an identical basket of goods and services in different countries. Inflation affects this balance, and deviations from PPP may occur due to differing inflation rates. Inflation differentials. If the inflation rate in one country is higher than in another, the purchasing power of the first country's currency decreases compared to the second. Consumers in the higher inflation country will experience higher prices for goods and services, affecting exchange rates. Effect on exchange rates. High inflation typically leads to a depreciation of a country's currency. Investors and traders may anticipate lower purchasing power in the future due to rising prices, making the currency less attractive and lowering its value in the foreign exchange market. Interest rates and inflation. Central banks often adjust interest rates to combat inflation. Higher interest rates can attract foreign capital inflows, increasing demand for the domestic currency and appreciating its value. Conversely, lower interest rates to stimulate economic growth may lead to depreciation due to decreased demand. Relative inflation rates. Investors compare inflation rates between countries to determine expected future exchange rate movements. If a country has lower expected inflation than its trading partners, its currency may appreciate. Central bank actions. Central banks may intervene in foreign exchange markets to influence the exchange rate, especially if they want to counter the effects of inflation. Their actions can impact the value of the currency. Inflation expectations. Exchange rates can be affected by expectations of future inflation. If investors expect high inflation in a country, they may sell off its currency, leading to depreciation. External demand and trade balance. Inflation can influence a country's trade balance. If a country has higher inflation than its trading partners, its exports may become more expensive, potentially leading to a decline in demand and a negative impact on the trade balance. Commodity prices. Inflation can be influenced by changes in commodity prices, e.g., oil. Commodity price increases can lead to inflation, which in turn affects a country's exchange rate due to its impact on purchasing power. Understanding the relationship between inflation and currency exchange rates is crucial for policymakers, businesses, investors, and individuals to anticipate and navigate the dynamics of international trade and finance effectively. Thanks for watching, and don't forget to like, share, and subscribe.